Vinayak Chatterjee is joining us this morning as well. Vinayak, let's get your perspective. Tell us about the Capex cycle. When we compare it to 2003, what are some of the factors missing? Just taking off from where, Pankaj left off in terms of describing the setup. Just share with us your perspective.
Look, it is too difficult to predict anything about a revival of the current Capex cycle, and I'm only referring to infrastructure. I'm not referring to manufacturing or anything else. The situation vis-a-vis what was just said and what we are facing today, as has been presented, is markedly different. And while the income tax cuts have been seen by the infrastructure sector as a mood upswing, shall we say, step, and a demonstration of the fact that government is cognizant of the situation and this is a beginning of a series of further steps to turbocharge the economy and economic growth. The mood in the infrastructure sector is still very, very cautious, and I will tell you 4 things that could be done to actually ease the mood. One is release of overdue payments. I think this buzz has now reached all corridors of power, and there is a huge issue of release of overdue payments by statal entities, both at the center and state level. This is further compounded by the fact that private sector wins about 80% of the arbitration cases, and arbitration monies are just not being released because, as a practice, a government officer, if he loses an arbitration, just refers it to the courts. So even I understand the NHEI official figure of monies stuck which are supposed to be released for arbitration is to the order of 70 to 80,000 crores. Now you can expand that to the rest of the economy. There is a huge problem of bank guarantees. Companies, even if they have to bid for new EPC jobs, do not have the cash available to put up the stiff margins that bankers now require. Good companies earlier had 0% margins, they have moved to 5%, and other companies which are not that well rated in terms of credit ratings have been asked to put anything up to 25% to 50% margins. So bank guarantees are very, very hard to come by, and in the absence of bank guarantees, and the banks themselves are very cagey, they don't want to give bank guarantees. The bidding process for EPC is seeing very subdued interest. And finally, there is an apprehension that with the fiscal stress in the central government, which was visible from as early as February, certain cash transfers from the Consolidated Fund of India to various government departments and institutions is just not happening with the size of the flows required, and therefore there are concerns that there may be delays in the burst of new fresh orders, whether on EPC or hybrid annuity. Now, unless these basket of apprehensions are allayed partly or wholly, the mood in the infrastructure sector continues to be subdued. But let me stop here.
Talk about the Indian markets, Vinayak. Do you expect after these tax cuts, a lot of MNC or FDI flows will increase in India? And can that then thereby act as a big trigger for a pickup coming in the entire cycle?
I have mixed views. I do believe that the implication of tax cuts will be felt positively by profit-making companies, and it will add a certain amount to their free cash flows at the end of the day. Is that a sufficient reason for bringing investment in? I don't think so. I think decisions on investments at the board level are based on 2 factors. One, existing capacity of existing plants shall be reached or about to breach 80%, and a clear visibility of an uptick in demand. So investment decisions will be taken on parameters which are different from a certain increase in the bottom line, cash bottom line, because of a tax break. The other point is that maybe, so far as attracting investments are concerned, a fairly hefty investment allowance would have been in order over and above this income tax, shall we say, break. I personally believe that investment allowance has a far deeper impact on attracting fresh investments than an income tax break. But that's my point of view.
But do you really think the super cycle in Capex can be slow as well? You know, select a certain sectors with C investment and not like all sectors going up in one wave as we saw way back in 2003.
Look, this is a new word I'm hearing this morning. What are you calling it? Super? Say that again.
Calling it the super cycle in Capex.
Super cycle in Capex. Let's forget the word super. I'd be happy to just get an uptick in the regular Capex cycle in the infrastructure sector. Super can wait. But the point here is that we have been arguing from the infrastructure sector that the chief economic advisor has very clearly positioned investment-led growth as the virtuous cycle to stimulate the economy. So we were actually advocating and still advocate that it would not be improper for the government to take a certain relaxation in the fiscal deficit number. When it was about 3.2, we had said a 0.5% relaxation in the fiscal deficit target, accompanied by ring fencing that extra 0.5%. Rough maths is that 0.1% gives you 2 lakh crores. So 0.5% of the relaxation of the fiscal deficit will give you 10 lakh crores. That money could have been used to be pumped into public expenditure in infrastructure to revive the growth impetus. What we have now seen, honestly, what analysts are saying now, that with the tax cuts and with the rise in petroleum prices and the decrease in revenue collections, we are anyway likely to hit about 3.9 to 4% fiscal deficit. So the headroom for fiscal deficit for public expenditure has currently been eaten up by these other measures, right? So what we have seen is the fiscal deficit space exhausted by what one would call revenue compression, and we have been arguing for expenditure expansion. Now, the question is there still headroom? I would even go far to stick my neck out to say that currently we do not have any choice for another 0.4 to 0.5% of fiscal deficit expansion, but very clearly use that funds for public expenditure in national asset building infrastructure and ring fence it so that it is not, shall we say, withered, or it is not used away in unproductive expenditure, and the public and analysts and the world community get to see that this extra 0.45% is actually transparently being used for nation building activities. But let me rest here.
I'm not going to use the word super, but with rates, Vinayak, being as low as they are right now and tax cuts also reducing cost or increasing the cash flow, do you expect IRRs of various projects to be more viable than they were before?
See, when an entire sector is trapped with liquidity or is in a liquidity stress situation, Excel spreadsheets on future investment decisions based on IRR calculations which are a result of reduced income tax and income tax rates are actually not particularly meaningful, because these infrastructure projects have a long tail. They go from 30 to 60 years. The immediate issue is that to get into a new project, you will have to put up your share of equity, right? You will have to have a balance sheet capacity to take fresh loans. Those are the issues which are on entrepreneurs' minds now in the infrastructure sector. So tinkering around with an Excel spreadsheet by saying my IRR increases by 1.5 percentage points because of these, and therefore I'm kind of rushing out to invest is honestly a no-brainer.
Thanks for joining us this morning, Vinayak, and taking us through the latest there and how you expect things to shape up. Vinayak Chatterjee from Feedback Infra joining us this morning.